All right, so we've got quite a few questions here. Lorna will be joining us very soon. And there's quite a few questions here. The first one I want to start with is this one. So there's a viewer there's an audience member that's asked, I've been investing for the last 2 years, and my friends always tell me to buy the dip, so I've been buying the dip as the market is going down. But the dip keeps dipping. So what do I do? So I think this is a question, I think we can start with Vasu for this one. If the dip keeps dipping, should I still keep buying?
Okay, this is a... Can you hear me? Okay. Tough question. Thanks, Edward, for the toughest question being directed at me. Just kidding. But, I think eventually, before you start dip buying, I guess it's also a question of looking at the market fundamentals to see whether the bad news has been sufficiently priced in, whether the valuations are looking more attractive before you start the process, right? So, for example, the current market, global equities are down almost 25%. The valuations based on PE ratio, as I said, is roughly about 1.5, 2 standard deviations below the 5-year average, which seems relatively attractive. On that basis, then, in the last 11 months, we've had so much of bad news. Ukraine war, COVID supply disruptions, blah, 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 and things are still playing out. And probably, in the next 6 months or so, you'll see some of these concerns about inflation, interest rates, recession being played out even more. So, as they get played out even more, as valuations reflect some of these concerns, things will start looking more and more attractive. So, things may dip, but the whole idea is nobody can pick the bottom. Nobody can really pick the bottom. And I can tell you this, Chris will tell you this as well. It's impossible to pick the bottom. We are so-called experts. We're all sitting here, we call ourselves experts. What we can do is help you to analyze the market. But I think it's very difficult to time the precise bottom. So when people tell me, is this the time to buy? I can tell you, I don't know. Because, honestly, the interest rate picture is still playing out. The inflation picture is still playing out. The recession fears are still playing out. But the good news is, a lot of these concerns have been priced in to some extent. The markets have fallen 25%, right? And the markets are a discounting mechanism. They don't wait for things to happen. They discount to some extent what is going to happen in the future. So some of it has been discounted. So you cannot pick it right at the bottom. So, from my perspective, I'll do what we call DCA or dollar cost averaging and maybe spread it out, over the next 6 months, 9 months, maybe even 12 months. It's better to stay invested, have some investment in the market, than to be completely uninvested in the market at this juncture after a 25% correction, because you don't want to be a spectator. When you try to be too smart and you try and time the market and the market start running and you say, hey, have I missed the boat? Or maybe this will come down again. So, you try to be too clever, right? And you develop behavioral biases. And you don't want to do that. I think, as I said, at this juncture, a lot of the bad news has been priced in. 25% correction. A bit more may happen, but, hard to really catch the bottom. So a DCA approach is good. Of course, when you buy, you dip, and it may dip lower, it's possible. But don't look at what happens at every twist and turn, It's like weight watching, which is why I never lose weight, You guys who see me around will know I've never lost weight because I keep watching the weighing scale, right? You cannot, right? You have to take a longer term view, work on the fundamentals, work on the foundation, and then let the money work for you over the next few years. You've got to be patient, because if you're not patient in this market, then, you're going to miss the real upside by, trying to be too smart and moving at every twist and turn.
Thanks for that, Vasu. I want to bring in Chun Ting here because, Chun Ting, you mentioned something earlier about a roller coaster and falling off. That's related to our top voted question. This audience member is asking, I'm currently in big losses for my investments. I feel like selling off everything. I never want to buy anything again. Should I still continue to hang on? I'm worried the markets will continue to fall. So this is related to what was asked for Vasu earlier, but you mentioned about falling off the roller coaster, right?
Yeah, I think what I'd like to ask is, or ask you to ask yourself is, what is actually your plan for this amount of money that you have put in? What was your goal? What was your time horizon? And that relates to the need and your ability to take risk. Now, if this was for something 10 years ahead, 15 years ahead. Has that changed? Has that changed? Say, I don't know your circumstances, but say your retirement suddenly got brought forward 5 years. You need to do something about that, because that fundamental of how you form that plan has changed. Otherwise, you should stick to your plan, because if you sell it now, then you're actually turning that temporary decline into a permanent loss, and you're fallen off the roller coaster and you die. And then the worst thing is, after you die, everybody else goes up. The fiercer those who can stay invested, once the market comes, you reap back everything, right? If you have that time horizon. We've shown this time and time again. So if nothing has changed with your need or your ability to take risk and therefore reap the return, then you should stay invested. Now, I'm assuming also that you are invested in the broad markets, because what Chris Tan said about long-term markets applies only to the broad market. It doesn't apply to your 1 stock, your 2 stock, or even your 10 stock or 30 stocks. Okay, so these are some of the assumptions that I'm making of you, right? So all the work that has been done about your investment should have been done before the volatility happened, if you had a proper advisor, right? If that is not the case, I advise you to really take a look according to this, your need, ability, and willingness to take risks. But in most circumstances, I suspect selling everything and never investing again is probably not the answer.
Thanks very much for that, Chun Ting. And diversification, folks, very important not to put all your eggs in one basket, because if the basket breaks, all your eggs are gone. Next question is for you, Lorna, then will be for Chris. Lorna, this question is from an audience member asking, with the present high inflation environment, a potential recession looming, what about those who are going to retire soon? How affected are they going to be, and what can they do?
Yes, I would be concerned about this risk that I was talking to Chris earlier. We call this the sequence of returns risk. It's one of several risks that retirees face. So this risk may happen when you have a sharp and prolonged downturn just before your retirement or in the early stage of your retirement, and it sort of it severely impacts your withdrawals, and as the negative effect is that you might not be able to, your funds may drain faster, over time, and then you're not able to recover fast enough, even if you have good years, good performance in your later retirement years. So to mitigate this SOR risk, then I would encourage all of you to have a diversified investment portfolios. Don't just depend on one investment product, so to speak. And if you have a short runway to your retirement, then you can look at some of the investments that I pointed earlier in my slide, like income portfolios. Definitely look at fixed income, which has been quite attractive these weeks and months, and retirement insurance plans. At the same time, have a long-term view, because we do not know how long we're going to live. So also have an equity portfolio, of course, with the help of professional help, to get a proper asset allocation in such a portfolio, which you can draw down from in the future.
Thanks very much for that, Lorna. Chris, you mentioned earlier that we're going to be probably living for quite a while more, even after we retire, right? So this is a question from an audience member who's asking, do you have any tips on how to recession-proof your finances? How do you protect your finances, your assets from recessions?
Yeah. Just before I answer that question, just now when we were talking about buying a dip and then it goes deeper, and I was laughing to myself, because it explained exactly the relationship between my wife and me. So every time when she sees something and she wants to buy, she will always wait for it to go down further. And then I cannot tahan, because I go and shop with her for a long time and I want her to buy, you know what I mean? But she'll say, no, I think it will go down lower. I'm the other thing, at the other extreme. When I see something cheap, I just buy. And I'm very happy I bought it. And then my wife will wait, and then no more. The item is gone. So moral of the story is that if you need something, if you get a discount, just buy it. You are not better off, but you won't be worse off, right? Okay, so I thought this was a very tough question, Edward. How do you recession-proof your finances? I guess as long as you have emergency fund and you have income, you're fine. Nothing else really matters, right? I mean, the world can go on a downspin, the markets can be down, and you've got cash in your bank, and you're still holding on to a good job, and you have an income coming in. I think it's fine. If there's a recession, you lose your job, you got an emergency fund. If you got your income, you're okay. So in 2008, Warren Buffett was actually interviewed. I can't remember the TV channel, and they asked Mr. Buffett, right, the stock market is crashing. What advice would you give? And then very strangely, Warren Buffett said this: if you're a good doctor, go and treat the patient. If you're a good teacher, teach. And all that. And people wondering like, what, this fella won't put it, No, it's like, answering my question, But if you think about it, what Warren was really saying is that, what do you worry so much? If you have got a good job and got an income, you really shouldn't be worried too much about the stock market falling because it's just temporary. Yeah, so I hope that sort of answered the question.
Yeah, thanks for that, Chris. And also, I mean, if you've got CPF, that's immune to recession. Nobody's going to take that money away from you. It's going to be there until you're 55 and then 65 to get your money out. So do a bit of advertisement for Wei Jin.
If I may add to that question, the answer to that question, I think it's a good time to also try to stress test your financials. So now that the inflation rate has gone up and it may remain elevated at about 3.5, for after next year, maybe 2024, it might remain elevated at that levels. Then use that 3%, 3.5%, 4% to stress test your financials right now. Go back to basics. Make sure you have, like what Chris says, your emergency cash. Look at your budgeting system. Make sure that you do not spend unnecessarily. I mean, there are a number of financial planning tools out there, from the banks as well as from the other portals. So this is a good time to have a good estimation of what you spend and save every month, and use cash management accounts to help you get higher yields for your lazy, idle savings, So these are some ways that you can try to keep up with inflation.
Thanks for mentioning that, Lorna, because we have the next question from an audience member asking exactly about that. I'm going to go to Vasu for this one, and then I'll ask the rest to join in also. Vasu, so this, as our speakers have mentioned, and as you have talked about, everyone is talking about fixed income assets now. Everyone wants to lend money to the government. Everyone wants to do it. The government is giving us amazing interest rates.
Yeah, because we know the government will pay us back.
So, government is not a bad debtor. Government is a good debtor. We believe in that. But then, we know also that in the US, the Federal Reserve has promised that they will raise interest rates. On their dot plot, it says 4.9%, so we aim for 5. Okay, so if 5% is the base rate, should we be buying fixed income assets today, or should we wait? Vasu, what do you think?
It's a tough one. I mean, as interest rates go up, obviously bond prices will come down, right? But at the same time, as I said, bond prices have already corrected very, very sharply. They're down, based on the global bond index, is down, I think, 20%. 20% is probably one of the sharpest drawdowns you've seen in bond markets in history, right? So actually in the bond markets, if you talk about the corporate bond market, even if you don't include the government, you're already starting to see opportunities emerge. In the investment grade space, for example, you're starting to see opportunities emerge. You can actually buy bonds which can give you quite decent yield, right? Can give you quite decent yield. And I think it depends on your objective. If you are looking to clip the coupon and looking to make income, then some of these investments make sense. For example, okay, I guess we'll be going into this discussion a bit later, but just to jump the gun a little bit. For example, T-bills, right? When you put your money into T-bills, it's for 6 months, right? And there's what we call reinvestment risk, because after 6 months, you've got to think about how to reinvest it for higher returns, right? So there's people who believe that, okay, I want to invest in T-bills. It's not a bad thing. It's a good thing, actually, to go ahead and invest in T-bills because the yields are quite high. But if I want to clip that higher yield for a longer period of time, then I put it into a bond with a longer tenor. Maybe a 3-year bond, a 4-year bond, a longer tenor. Then I lock in that higher yield for a longer tenor, right? And that assures me, so I don't have to keep doing this every 6 months. right? I find something that maybe gives me 5% or 5.5%, and yeah, I don't worry about the reinvestment risk. But at the same time, the flip side is that you do that, you get in now, you get say 5% or 5.5% on an investment grade bond, and you're sitting on it, clipping that 5.5%. I mean, you're enjoying that yield. But at the same time, as you said, interest rates are headed higher. It's possible that as rates head higher, your portfolio value will decline in the short term, right? Your portfolio value could decline in the short term. There are two forces here. Rates go up, your portfolio value may come down in the short term. But at the same time, if rates go up, it may cause a recession, right? As high as 5% or more may cause a recession in the US. Now, when a recession happens, what do you think is going to happen next? The yields, the Fed will start cutting rates. And then these things that you're holding will appreciate in value, right? So it is not a zero-sum game. So in other words, you buy, you get 5.5%, you clip the yield, but you must take a long-term view. You must take a view of at least 3 years, 4 years, whatever it is. As the rates go up, it may put some pressure on the bond prices, but the bond prices have already come down quite a lot. It may put some pressure, but when recession happens and the Fed starts cutting rates, these prices will recover and go up higher. And in a recession, people start looking for very safe instruments. So investment-grade bonds will be sought after, right? So you know, I think when you look at it 5%, it makes sense as long as you're prepared to take a view of like 3 years or so, and you're happy to accept the fact that in the short term you could suffer some potential downside price pressure, but in the medium term, in other words, in the next 2-3 years, that price pressure could correct itself and you could see prices recover and maybe even go even higher. Yeah.
All right, thanks for that, Vasu. I'm going to ask Chris and Chun Ting the follow-up question to this one. So you've got this very, very good yields on these fixed income assets. It used to be there is no alternative, Tina, right? That's why buy equities. But now there is an alternative. Equities look terrible. The alternative is fixed income. Do we think that this is a short-term thing, or is there going to be a mean reversion? Stock's going to come roaring back. I'll start with Chris, then Chun Ting. Chris first.
I was hoping you asked Chun Ting first so that I know how to copy the answer. The truth is, I don't know. I mean, anything I say doesn't matter, right? Because I don't know what's the future. And it is in a way related to the earlier question, and Vasu answered it. It really depends on what you are buying these products for. I mean, both have fallen. Equities have fallen, bonds have fallen. What are you buying this instrument for? So if you are buying it for income and you buy a direct bond, it's the same story I gave between the relationship between my wife and me, right? I mean, if you're happy with the coupon, yeah, you know, the yield may go up. It doesn't reverse, and the yield continue to go up means the price keep on falling. If we are not greedy, then it's okay because you're happy with the income, right? And you're getting that income. As long as you hold it to maturity and you're buying an investment grade, you will get your money back. If you're buying a bond fund, the managers are doing the thing for you, right? Certain bonds in their portfolio is going to mature and they're going to buy new bonds at a higher yield. So your expected return of that bond fund is going to go up, so you are quite happy about it. If you are buying bonds for the purpose of moderating the volatility of the portfolio, because you just don't like the equity volatility, right? You know it's going to, in your mind, you know that it is definitely going to come back. Your mind understand, but the brain understand, the head understand, but the heart cannot connect, right? Right? So the brain can say, I know it's going to come back, but every time it goes down, the heart cannot take it. So yes, while you know it's going to come back, you need to moderate it. So you put in some bonds. So you just buy it anyway for the purpose of cushioning that volatility. Yeah, so I try not to guess where the markets are going because it's most of the time we are wrong. Many years ago, I used to do this market outlook for 财经追击, and I used to tell this joke that the second question was, what do you think the Singapore stock market would be like? And then I always tell people that whatever I say, just do the opposite. Because 80% of the time I'm wrong. So I have stopped doing all this sort of like thinking where the market is going. Yeah, Chun Ting.
Yeah, I think that sometimes we look at market outlooks, we want to know where to buy, whether it go up and down. I think we forget that we are not fund managers and not bond traders. The people who have the toughest job in these are fund managers and bond traders because they are judged based on their short-term performance, otherwise their clients say they are no good. But actually, you're not that, right? If you bought that 4% bond, as long as the bond doesn't default, you get 4%, right? Why are you so envious of the next person who got it at 5%? You're not, if you're a fund manager, you're in trouble. But you're not a fund manager and you're not a bond trader. You do what it takes for yourself that makes sense. Now, I think there's a lot of confusion about fixed income and bonds because you need to understand that bonds have a few components of return. And if you look back now we still say, well, yields going up, don't buy bonds. Do you remember what it was a few years ago? Yield so low, buy bonds for what? Right? And why is this so? Because each of these views addresses separate components of return, but not the total sum of what returns in bonds. There are three components to bond returns. One is the yield, right? One is the yield. So whatever the yield is not essentially the coupon. Just now I think Chris gave an example, right? 4%, 5%, and then basically the equivalent of that yield, right? So he's done the hard work of explaining yield. There's another component that is to do with the price, right? This price is what happens when you get a bond and then suddenly the interest rate goes up, your price drops so that it matches the equivalent of the market. Now this is like sort of your capital gain, and this is caused by yield curve changes, which you cannot control, you cannot predict. Right, so this is the second component, which is your capital gain. That is why in the years when interest rates were zero, you can still earn money from bonds because there is that potential for capital gain. There's a third component that is very unique to bonds because bonds are not like equities. Yeah, equities got price, equities got dividend, a bit like bonds, right? But equities got no term. No term. You buy Apple stock. Is there a 4-year Apple stock and a 5-year Apple stock? No such thing, because a stock is perpetual. It's a perpetual security, right? But bond got 4-year, got 5-year. In a normal yield curve environment, the 4-year gives you less yield than a 5-year. Normal, okay? So it's upward sloping. So when a 5-year bond, after 1 year, right, that is what we call the roll down yield. You get a capital gain. So there are three components to bond returns. So don't just focus on one or two. So in fact, in a rising yield environment, it can actually benefit you. When does it benefit an investor to invest in bonds? When your time horizon exceeds the duration of your investment. So if you have, say, a 5-year time horizon, and then the yields go up, immediately your price falls. But then you get more and more, right? So the bond manager does this for you. And that is when you have a benefit, because around that 5-year, it will turn around and you will actually benefit. This one is just mathematical, you know? It's nothing to do with where markets go and up. So please be concerned then about financial planning in that context. Again, your risk, ability, and willingness to take risks, right? Bond markets have suffered one of their worst years in about 20 plus years, since 1997. The worst years is an anomaly. If I need to take a bet, which I try not to, but if I need to take a bet, actually our fixed income looking quite attractive. Now, because the curve is inverted, when it finally rolls out, the curve should reinvert, then I get again, you know, that roll down yield, and then of course my yields by the time are higher is actually good news, right? So it depends again on you, your time horizon, your purpose, and your willingness to stick with it. Yeah.
Thanks for that, Chun Ting. So you can't fight gravity, right? The reversion to the mean. So the next one is a bit of a basic question for you, Lorna, but because you work for DBS, so people ask you this all the time. So now they've got fixed deposit, got T-bills, got Singapore savings bonds. What are the differences between them? What are the pros and cons? So Lorna, I'm going to direct this question to you because this is something that I think a lot of people are they're trying to choose. Like, I've got good yields on fixed deposits, I've got good yields on T-bills, I've got good yields on Singapore savings bonds. What are the pros and cons of these?
I think most of you will be very familiar with fixed deposits because it's a very traditional product. So with fixed D, basically you place a deposit and then you get the interest at the end of the period that you have placed it for, right? For Singapore savings bond, it's quite of a unique product because it's meant to encourage retail investors to learn more about investing in bonds, and they wanted to increase the capacity of the range of products in the capital market. So for Singapore savings bonds, there's a cap of 200,000, so that's the max you can put in. The minimum you can put in is $500. And what I like about SSB is you know ahead of time what the interest is going to be. So for instance, this month's tranche is 3.21%. That's for the 10-year average yield. And but the first year, if you're just keen to go in for the first year and you intend to redeem it after the first year, then you're looking at 3.08%. For the first year of this year, this month's tranche. So for SSB, if you think you like the interest structure, you're happy with that 3.08 for the first year, and you're happy with the 3.21 for the for the average for the 10 years, then you can safely put your money in, and if you decide that you need the money suddenly, you can always redeem it at $2 admin fee. So to go in to buy is $2, to get out of it is also $2. So that's the flexibility that I really like. For T-bills, the yields have gone up mainly because the US Fed has been increasing interest rates. So with T-bills, if you go in for the non-competitive bid, you actually don't know what the rate's going to be, but because you know that the rates have been going up, and as Chris said, if you're lucky enough and you got this month's latest tranche, you'll be at 4.19%. So for this one, there's like no cap in that sense. You can put in beyond 200,000 if you have that kind of money, and you can get the interest first, upfront, unlike a fixed D. And at maturity, you get your entire principal back. But you do not know what exactly would the cut-off yield be if you're putting it as a non-competitive bid until the auction is over.
Thanks for that, Lorna. And for those of you who are wondering, what's this competitive, non-competitive? Please just go and Google. It's right there. Okay, there's a percentage set aside for the competitive. There's a percentage set aside for the non-competitive. All right, so T-bills are slightly more complicated. Risk-wise, still good. You're lending the government money. Vasu,
Can I just say something?
yes.
I'm not an expert in this sort of things, but in my view, intuitively, a couple of other differences to point out. Number one, I think when you buy Singapore savings bonds, T-bills, and so on and so forth, you can only buy it under one name, right? So you can't have two names. So in the case of fixed deposits, for example, you can have two names. So in the event of like joint alternate account, right? So in the event one person passes away, the other person will have access to the money without having to go through the will process. But in the case of T-bills, savings bonds, and so on and so forth, is one name. So if something happens to that person, and it was, say, a joint account money that was put into a T-bill, then, you got to go through the probate process. So that's one difference. I think the other difference is also that, with a fixed deposit, say you put your money into a fixed deposit, it earns you 2.4%, right? And suddenly the stock market plunges, right? And you say, wow, okay, this is an attractive opportunity. I want to invest. I've got my FD at 2.4%. So what do you do? If it's me, right? If you've got a bit more risk appetite, I'll just go to the bank and say, I want to break my FD, right? Break my FD is fine because you lose your interest, 2.4%, but I get my capital back and I can buy the markets, right? In the case of T-bills, right, what happens is that if you decide that you want to get out, the process is you go to the bank and you tell them, I want to get out. And the bank then gives you a price, right? They quote you a price. And that price, if interest rates are headed higher, could be lower than your purchase price. So you purchase at $1, it may be 97 cents, 98 cents. So you end up potentially losing money. With the FD, that will not happen. You lose interest, but you may not lose the principal. So T-bills, if you hold it all the way to the end, it's fine. But if you're trying to get out in between, to redeploy your money on an opportunity in the stock markets, you may end up losing money. So just bear that in mind. Yeah.
Thanks for that, Vasu. Also,
Edward, I'm sorry. I wanted to say a little bit about T-bills because everybody is very interested in T-bills. And I was reminded by Vasu just now to clarify this. Yeah, and I thought it's very important to clarify this because in my presentation, I mentioned that you can optimize your OA with your T-bills. Okay, so there's a bit of, I wouldn't say complexity, it's a timing thing. Okay, because, okay, let me see how I can explain this simply. When you apply for the T-bill this month, let's say, right? The money leaves your CPF account. So when CPF board calculates your OA interest, the money is out of the account for that month. So you are not being paid that interest for that month. And then the T-bill is about 6 months, right? So effectively, you are losing interest on your OA for about 7 months, okay? So you cannot use you cannot look at the T-bill and say that as long as the T-bill yield is above 2.5%, I can do that. Okay, because the T-bill, you get the interest for 6 months, but you're losing your OA interest, which is now 2.5% divided by 12, right, every month, right, for 6 months, right? So if you want to know the sort of the break-even interest before you should move your money out from OA to T-bill, okay, it's 7 months divided by 6 multiplied by 2.5. However, if you want to be even more conservative, because your money can leave the OA for 8 months. Why is it like that? Okay, for example, the announcement date of the T-bill is this month. The auction date is end of this month. The issue date is next month. You get what I'm trying to say? But when you buy, the money is already out of your CPF OA account this month, 1 month gone already. You are not earning OA interest, right? And then, well, you may have to wait another 7 months before your T-bill mature. Total, it could be 8 months, right? So therefore, if you want to be super conservative, it's 8 divided by 6 multiplied by 2.5, which is about 3.3%. But, well, if it's too difficult, just leave your money in OA, it's not bad, right? But if it's like, I would say that for the T-bill right now, like if it is 4% and above, it's fine. Yeah, but I just wanted to clarify this because we cannot use the 2.5% as the break even to buy T-bill. It's not like every time the T-bill is more than 2.5, it's okay. It's not like that. Okay?
And don't do it for like $3,000 and then you have to take the Grab.
Do it for $3,030.
Grab
Okay, no,
very
I'm just
expensive
kidding.
right now. You take the Grab down to the bank to do it because OA to T-bills cannot do online also. Yeah. So all these ancillary costs, and then must pay $2, and then please don't redeem it the next month and to pay another $2 and churn it.
I sort of regret it when I put it up. Honestly, I regretted it. Yeah, but since I put it up already, I just need to explain it. But thanks, Vasu, for reminding me. Yeah.
So thanks very much for that. Also, free advertisement for Chun Ting on Money Owl's website. Because Vasu mentioned this, it's a free will writing service, free of charge on Money Owl's website. Very important. I actually use this. Very simple, all right, and it's so important for everybody to have a will. If you don't have one, it is so leceh for your family, you will not believe it. Okay, have a will.
It's a simple one. I mean, it might not meet everyone's needs, but it's better to have one than not to have one in the interim. Thanks
for that, Chun Ting. So I'm going to start with Chun Ting for this. We're going to work back Chris, Vasu, and Lorna. So the most voted question here, and I'm going to end with this, so quick answers from each of you, is something that was very popular when I was a banker quite a while ago, which is currency. All right? This audience member was asking about the UK, because the pound has fallen a lot in a very short period of time. And of course, if you look at rising interest rates in other countries, it's likely that interest rates will be more attractive if you hold deposits in that currency. So we're talking about Forex. Chun Ting, what are your thoughts on non-SGD denominated investments?
Okay. There's a joke, when I was in fund management, that the people who are the fastest are the Forex people. They're also the people with the not so clever ones. Right? Forex, you want to talk about volatility, right? it just outstrips everything. That's why when you buy fixed income, we say that buy it hedged to your home currency. So I'll be very conservative that say that if you have no spending in that currency, just forget it. You know, don't think, it's no free lunch, you know, just because it's higher rate there, it's because there's a currency risk to it. And this is the interest rate research theory, right? Is that the rates are higher because there is that is compensated by the currency. So there is really no free lunch. But of course, I have a colleague who's sending daughter to study in UK. So when the pound dropped, I said, good time for you, but again, don't try to time. So to me, it's absolutely just speculation when it comes to this. So it's not something that I would recommend for us to be conservative.
Thanks, Chun Ting. Chris, quick thoughts on Forex?
Yeah, this time round, I hope I was the first one to answer because she answered already. I mean, it's true, if you don't have the need for that currency, why take that currency risk, right? But I maybe just add this, that generally we will know that when the interest rate, we always think that when interest rate is high, the currency will strengthen. And that's not exactly correct. It is the expectation of interest rate rising that cause currency to go up. So what that means is that if you move your money from a lower interest rate like Singapore, let's say, to a higher interest rate like, say, the US, you have to expect that there is a risk that the currency may fall. So the extra interest that you earn, you will lose to the loss of that currency exchange. Then not worth it already, right? Yeah. Now, Singapore right now, the interest rate, I know it's rising, okay, but it is not as high as other countries, and this is not I say one. You go to MAS website, they explain this, right? That there is a chance that the Sing dollar will strengthen, right? It's an interest rate parity thing, and I'm not going to explain this technical thing, yeah, but just to say that just because the interest rate high, you move the money there, you will gain the interest, yes, but you have no need for the currency, it's quite likely the currency is going to fall and you're going to suffer the FX loss. Can you take this loss or not? If not, then don't lah. Sing dollar interest, not bad ma, right? T-bill 4%, 4.19, yeah.
Thanks, Chris. Vasu?
Yeah, I think you've answered the questions quite comprehensively, but currency markets are highly speculative, right? So it's not meant for everybody. Very highly speculative. I mean, there's so many moving parts that impact currency markets, so you've got to be very careful. As what Chun Ting said, I mean, you may be attracted to the high interest rates, but the currency takes a plunge and the high interest rates are just wiped out, right, very, very easily. So just to give you an example, I mean, the US dollar, for example, the US dollar, I think many of you know it's in the limelight, right? It's like roaring ahead like crazy. In fact, the US dollar is up, I think, 24%. On the DXY index, they use this thing called the DXY index, up 24% since the beginning of last year. So I was looking back at the chart before I came for the meeting, before I came for this seminar, right? I was looking back the last 22 years. And I think this 24% increase is one of the sharpest increases in history, right? There were two other episodes when the currency also went up by about 24%. Two other episodes, as sharp as this. It's a very sharp increase because the Fed is the first to increase interest rates and very, very aggressively. So that has pushed the dollar up. So, the natural tendency is like, wow, dollar is the way to go, we should. But no market goes in a one-way street, right? There's no one-way street. It doesn't just keep going up forever. So historically, we look at the rallies, 24%, and then after that, the rally dies off, right? And so, as Chris said, the one factor that drives the currency market is expected interest rates, not so much actual interest rates. So the Fed may continue to push up interest rates, but if you notice in the last couple of weeks, the dollar has been coming off. The dollar has come off 3% on the DXY. And why? Because all of a sudden, in the last few weeks, a couple of Fed governors have said that, we might pivot to a dovish stance, a more, I wouldn't say dovish, they're talking about the market's expecting the Fed to go from a 75 basis point hike to a 50 basis point hike, but still hike lah. But that has altered the equation. So although the Fed is still hiking rates, the dollar is now like weakened a little bit. So you've got to be very careful about investing in currency markets. There are so many factors at play. Politics, economics, interest rates, you name it, right? So many factors at play, and you've got to be very careful. With currency markets, you're dabbling in a lot of risk.
Thanks, Vasu. Lorna, you had the shortest time for a presentation, so your thoughts on FX and also about general retirement. I'll let you have the last word.
Okay, I do find Forex trading or investment kind of speculative, so personally I don't go into it, nor do I recommend it. I would have I do have some pounds because the kids were schooling there. I had some property investments, but that's all I would just hold on to. With regards to retirement, I think it's good if everyone can start early and plan for it so that while you're still employed, while you're still healthy, you're able to review and make decisions in order that you can make the proper decisions and achieve your retirement goals.
Thanks very much. So thank you to all our panelists, Ms. Lorna Tan from DBS, Mr. Vasu Menon from OCBC, Mr. Christopher Tan from Provident, and of course, Ms. Chun Ting Weaver from Moneywell. Please give them a big round of applause. Thank you so much for joining us today.